So how do you know if the stock market is expensive or cheap? Or how do you know if the stock market is overbought or oversold? And here we have an indicator that is used by many investment managers. It's called the US Buffett indicator. It is called after the famous investor Warren Buffett, one of the most successful investors. And this indicator, basically what it does, it calculates, it's a ratio which is the stock market valuation or market capitalization of the stock market divided by GDP. So this is in the US, so it's a US stock market value divided by US GDP. And what you can see over the long term is that this ratio is going up. And we've got in blue, the blue line, which is the indicator, and the dotted line is an average. So you can see that the blue line will go up and down around following that dotted line, up and down. And when the blue line, when the indicator is above that dotted line, it means that the stock market is expensive. And when the blue line is below that dotted line, it means the stock market is cheap. Now, we've got some extremes, as you can see in 2000 and then 2020. So, for example, in 2000, the ratio, the indicator, nearly reached 150% of GDP. So the market value of the stock market was nearly 150% of GDP in 2000. And you can see when this indicator is overbought, because there is a big gap between the blue line and the dotted line, as you can see in 2000. So that means that the stock market was overvalued, it was expensive, and in general, you get a correction or a bear market. So we got the correction in 2000, and then after that, we had a massive decline in 2007, 2008, and you can see that the indicator went below the dotted line. And again, you can see by the gap between the indicator and the dotted line is a big gap in 2009, and that means that in 2009, the stock market was very cheap. It was oversold. And it is the time to buy shares, okay, in 2000. So if we go back to 2000, it was overbought. It was the time to sell, not to buy any shares. And in 2009, it's the opposite situation. It was a buy signal, basically. And you can see it worked very well, because since 2009, we had this massive rally in the market. And then again in 2020, this time, the indicator reached more than 200%. And that is a big number. It's bigger than in 2000. So you can imagine in 2000, it was overbought just below 150% of GDP, and now we are above that. I mean, in 2020, it went above 200%. And of course, in 2022, the market corrected. There was a big correction, but it wasn't like the kind of massive correction. The market went down in 2022 and then started to rally again. But I think that if you look at this, the position of the indicator, because that was recorded, the level we have, 185% of GDP was recorded on 19th of January. I think now we are higher than that, because since then markets have made new highs. So it means that the value is probably near 200% again. We are probably near the peak in 2020. So what does that tell you? It tells you that the market is still overbought. It tells you that the decline was in 2022 was just another correction, but not a bear market, really, not a proper bear market like in 2007. Because in a proper bear market, that indicator should fall below the dotted line, and it's still above it. And you can see even at the end of 22, it was still 150% of GDP, which is overbought. So despite the decline in 2022, the stock market was still expensive. So it tells you that today, with market making new highs, it's even more expensive. In conclusion, what's going to happen basically is that the stock market will go down again. You know, I don't know when, maybe in 24, 25, but there will be another big correction taking the indicator back to the dotted line.